All right, we're about to dive deep into one of the most seismic events in modern history, the day Lehman Brothers, a 158-year-old titan of finance, just vanished. To really get our heads around how this could even happen and what it all means for us today, we first have to appreciate the sheer mind-boggling scale of it all.
Just look at this number, $619 billion. I mean, that's not the budget of a small country. That was the value of Lehman's assets when it filed for bankruptcy. It's the largest corporate failure in American history by far. It's a truly staggering figure, and it's what set the stage for all the chaos that was about to unfold. So let's start right at the epicenter of the earthquake. Section 1, a titan falls. How on earth did a 158-year-old institution, an absolute pillar of Wall Street, suddenly just implode? September 15th, 2008. You gotta understand, this wasn't just another bad day on the stock market. This was the moment the ground literally gave way beneath the entire global economy. And the panic? It wasn't contained in New York. Nope, it went global. And it went global instantly. Which, of course, brings us to the central mystery here. How does something that seemed so permanent, so indestructible, just cease to exist? Well, to answer that, we have to pop the hood and look at what was going on inside the machine. And that brings us right to Section 2, the House of Cards. Because that's really what it was. We're going to break down the key ingredients in this recipe for total disaster that made Lehman so incredibly fragile. Okay, so ingredient number 1 was a massive all-in bet on the U.S. housing market. Lehman was just swimming in these things called mortgage-backed securities. Basically, you just take thousands of home loans, bundle them up, and sell them as a product. As long as people kept paying their mortgages, these things were like gold. But if they stopped, the whole structure was in serious trouble. The second, and maybe the most critical ingredient, was leverage. Now, leverage is an incredibly powerful tool. Think of it like a seesaw, right? When your bets are paying off, leverage launches your profits way up into the sky. But, and this is a huge but, if your bets go sour, it amplifies your losses just as dramatically on the way crashing down. And this chart right here just shows you how far out on that seesaw Lehman really was. A typical bank, might have a leverage ratio of around 10 to 1. Lehman Brothers? They were running at 30 to 1. 30 to 1. For every single dollar of their own money, they were playing with $30 of borrowed cash. The room for error was basically zero. And the foundation holding up this whole high-wire act? It was incredibly shaky. It was all built on short-term funding. So instead of stable, long-term loans, Lehman was borrowing money that had to be renewed every single day. The second lenders got even a little bit nervous about those mortgage bets and that crazy leverage, they just turned off the money top. And just like that, the company ran out of cash. Which brings us to Section 3, the domino effect. Because Lehman's failure wasn't some self-contained explosion. Oh no, it was the first critical domino that set off a catastrophic global chain reaction. This quote just nails it. It was a virus of fear. You have to remember, confidence and trust are the absolute lifeblood of the financial system. And overnight, all of it was gone. Banks just stopped trusting each other, and the whole system froze solid. This flowchart just shows the terrifyingly simple progression. It all starts with step 1, Lehman collapses. The shock from that immediately triggers step 2, the credit markets. The basic plumbing of the economy. They just freeze up. That freeze then leads to step 3, where other major global banks are suddenly on the brink of failure themselves. And finally, in step 4, the crisis jumps from Wall Street to Main Street, hitting jobs, businesses, and regular people all over the world. It was the absolute perfect storm of contagion. The sheer scale of that crisis forced a global rethink, which, thankfully, brings us to Section 4, rewriting the rules. How did the world try to make sure something like this could never, ever happen again? This comparison really lays it all out pretty clearly. The old system was just fragile. It had these tiny capital cushions to absorb losses, and this messy, unspoken assumption of government bailouts. The new system, on the other hand, is designed to be way more resilient, with much stricter rules and thicker walls of capital to protect against shocks. So what is all this actually meaning in practice? Well, first, banks have to hold way more of their own money as a buffer, a direct response to Lehman being so thinly capitalized. Second, They have to go through these regular stress tests to prove they can actually survive another massive crisis. And crucially, there are now pre-made plans, sometimes people call them living wills, for how to safely unwind a failing giant without triggering that catastrophic domino effect again. And this all leads us to our final and maybe most important section here. After all these new rules and all these changes, are we actually any safer now? This is one of the two huge questions that experts are still fighting about today. On one hand, you could argue that letting Lehman fail sent a powerful, necessary message. Hey, the government isn't always going to be there to save you from your own terrible bets. But on the other hand, did that so-called lesson come at way too high a price, making an awful crisis even worse for millions of people? And that brings us to the final, lingering question that keeps regulators up at night. Yeah, sure, the rules for the big banks are definitely tougher. But has all that regulation just pushed the risky behavior into the shadows? Into less regulated corners of the financial world? It's the essential question we have to keep asking ourselves if we want to be sure we've truly learned the lessons from that fateful day back in September 2008.